It was an interesting day on Wall Street. We saw consumer confidence numbers plunge. Fairly expected number, I would say, there, considering the circumstances surrounding COVID-19 that consumers are dealing with right now. It did lead to a little bit of a sell-off in the market. The S&P 500 was down about 0.5%, but maybe one of the more interesting developments here today was that this was largely a mega cap technology sell-off that we had today. In fact, the equal weighted version of the S&P 500 actually closed higher today. Remember, that's kind of been the reverse of what we've seen more often than not in the last several years. So we want to keep our eye on that story, see where it's going to take us, and see what it means for our posture here today. Then we'll get into our trade application example, where I wanted to focus on a sector that's been seeing a little bit of a turnaround here recently, and maybe implement a bullish sold put opportunity on one of the higher quality stocks of that particular sector. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 28th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, then go down to the description area, sign up for our email distribution list if you haven't done so already. That'll entitle you to receiving emails from us that'll not only notify you when these videos are ready for you to view, but it'll also give you a heads up on all the stocks in the S&P 500 that are giving you either overbought or oversold cluster signals. We're also heavy users of Twitter. I know David and I have both been much more active on Twitter here more recently. For instance, this morning I was talking about some companies that were cutting their dividends, another company that raised its dividend for the 25th straight year, so will likely become a dividend aristocrat with next year's list. So if you're interested in that type of commentary, make sure you're following me. My handle is @BrandonVanZee. One other quick note regarding that. Many of you know that I've gone to the Berkshire Hathaway meeting in person in Omaha for the last 15 years. And of course, this year is unique in many ways. And one of the things that unfortunately is the case is the meeting will not be held like normal, at least with an audience. So Warren Buffett will still be answering questions as he typically will, but it'll all be over the streaming. I believe it's Yahoo Finance that will do it. So anyway, if you're interested in my thoughts on that, just like other years, I won't be there in person, but I will still be happy to share my thoughts on Twitter. So make sure you're following me there if you're interested in hearing my thoughts regarding Berkshire Hathaway and Warren Buffett this Saturday. My handle is @BrandonVanZee. And then lastly, we have a presence on Facebook. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. As you can see, I've got chart 4B pulled up here in front of us. And as I mentioned in the intro, we were down about 0.5% here today on the S&P 500. We were actually trading up to start the session, and we sold off to end the session. So not necessarily a very productive day for the bulls. However, it wasn't enough of a sell-off to change the posture or anything along those lines. In fact, some of you that have watched this video long enough will recognize that we actually have what's known as a bullish intermediate confirmation signal here today on the S&P 500, and that occurs when the green line on the market forecast is considered bullish, which it is. Remember, anytime it's in the upper reversal zone, it's considered strongly bullish, and that combined with the red line, the momentum line, in the lower reversal zone on the same day. Those two things together do constitute a bullish intermediate confirmation signal. In fact, you can see we have it down below here on the NASDAQ composite as well. The downside of that is it is not considered an ideal signal. Some of you will know that what we try to do is gauge where is the blue line in relationship to this whole signal. And as you can see right now, the blue near-term line is positioned here between 80 and 50. Where we'd like to see that is between 50 and 20. It gives us more of a kind of a breathe out type of a scenario because remember, this bullish intermediate confirmation signal is meant to be a buy the dips trade signal. And while we did have a sell-off today, it wasn't an aggressive one. So I think a lot of people would agree that there wasn't much of a dip here to buy. So maybe we'll see that tomorrow when David reviews that with you. I did notice that this evening we had Alphabet/Google come out with their earnings announcement, and appears that Wall Street was very impressed with that stock being up $100 per share after hours, so kind of helping support the futures to a degree. So anyway, just be aware we do have a bullish intermediate confirmation signal on the S&P 500 and the NASDAQ Composite. However, neither one of them would be considered the ideal setups there. But as you can see, we do have those strong bullish postures on all four of our charts. Also wanted to take a moment to just point out right here, Russell 2000 was up 1.26% today. You can see that it was the only index that was even up today. The Dow Jones was only down by 0.13%. NASDAQ Composite was down the worst of these four, down 1.4%. Again, this was a technology-led sell-off here today, in particular the big FANG names and the Microsofts, the Amazons, the Netflixes, those types of companies were the ones that tended to struggle here today. So it was an interesting day where we saw leadership out of the small caps. You can see that there is something to report here as well with what Russell 2000. The green line entered the upper reversal zone today on the Russell 2000, and that is the first time it's been able to make that claim in over 3 months. You can see that the last time we were close to it was back here in about the last week of February or thereabouts, but it wasn't quite there. You guys that have watched this video for a while will recall that we were talking about how the Russell 2000 had been the lagging index. This was all before this whole coronavirus thing started here in the United States. So it's interesting to note that finally today we are back in the upper reversal zone on the Russell 2000, and that has not been the typical trading plan of the market. So it's something that is somewhat noteworthy, and we want to keep our eye on. A lot of times people will feel like it's a healthy sign when the small caps start taking a leadership role, because they are a little bit more easily manipulated. They are considered a bit riskier, and so when they are doing well, it is often felt like the market itself is willing to take on some risk there. So anyway, good to see that type of behavior there as well. Let's take a look at our 3 green arrows chart set up now. And in this particular case, we do have 3 green arrows across the board, so I'm not going to spend a lot of time on that because there's not really any change there other than just letting you know that is continuing to be the case. One thing I would point out that just caught my eye here briefly is you will see that the MACD histogram on the NASDAQ Composite is getting awfully close to that 0 line right there. And again, a lot of those big cap tech companies are the reason behind that. Let's go ahead and kind of maximize this chart here, show you some of those names. So here's Netflix. Netflix was down 4% today. It wasn't too long ago, a couple of weeks back, where we were all talking about how, Netflix was, one of those stay-at-home plays in the stock market where everybody's just, staying at home, not doing their work, and watching movies all day. We should all be so lucky, right? So anyway, it looks like the stock market is kind of unwinding that trade to a degree right there. Amazon is another name that has kind of taken advantage of this stay-at-home mindset where, the thought is people aren't going into brick and mortar retail quite as much anymore and everybody's buying their stuff online. Well, take a look at Amazon here. You actually got a red arrow on the MACD histogram on Amazon today, and I didn't check that on Netflix. Let me just see if that's the case. Yeah, so Netflix already had the red arrow on the MACD histogram. If we were to look at Facebook, we don't have the red arrow down there, but you did see Facebook selling off today by about 2.5%. If you look at Microsoft also sold off about 2.5%. Again, red arrow down below on the MACD histogram and kind of breaking down a little bit there on the chart. They do have earnings coming up here pretty quickly. And then take a look here at Apple as well. And Apple wasn't down as much as the rest of them, but it was still down 1.6% today, and it did still produce a red arrow on the MACD histogram telling us that there is a bit of a loss of momentum in the shares of these really large companies that we see here. In fact, let's use that as our segue to come on over here to some 12 grid analysis. And I wanted to show you the ratio charts, 5Q, in particular, this one right down here at the bottom in the orange color. This is the equal weight SPX versus the market cap weight. And so what we're using in this are ticker symbols RSP and SPY. RSP is not nearly as popular of an ETF as SPY. However, it is quite useful when you're trying to gauge whether it's the mega caps or the somewhat smaller companies that are leading the way. And if I were to kind of right click on this chart down below here, and let's kind of actually I'm not able to change it right there. We do that within our ThinkScript, so I'm not going to be able to do that on the fly. But anyway, you can kind of get the sense here what's been happening just in the last couple of days. So you can see a nice little bounce in these two candles right here back to back, and that actually takes us up and almost through this range that would take us all the way back here to basically mid-March. So when you're looking at these ratio charts and you're seeing it fall like it was happening from February here to the basically start of April, that basically means that in this case RSP is underperforming SPY, and that was par for the course. That's typically what had been happening in this stock market for not just recent months, but in recent years. This has been a stock market that has really been led higher by those biggest companies. In fact, I think it was just the last time I was in this presentation, I was mentioning, all those various tweets that I was seeing regarding the fact that the 5 largest companies in the S&P 500 now make up more than 20% of the index, and it's been several decades since we had seen that in the past. So it's a very rare moment where this has been a one-sided market, that all of the available market cap has been shifting from the typical 495 companies out there and into just the 5 biggest ones, at least at a above average rate. And so that's being unwound a little bit in the last couple of days, and we want to keep our eye on that particular story here. In terms of any other ratio charts here, one thing I should point out regarding oil. Remember, in this particular ratio chart, if you're a premium member of Market Scholars, remember this is chart 5Q for those of you that are following along at home. What we use in this oil to gold ratio here is USO. And I'm not sure exactly how this is going to look, but I think that when they do their reverse split, this chart might get kind of horsed up a little bit. Some of you have heard that oil prices have been giving the business to USO, and USO's share price is now so small that they're going to have to do I think it's an 8-for-1 reverse split. I saw that little notification pop up here on some of those platforms earlier today. So anyway, keep your eye on that. I'm not sure if this chart is going to get messed up because of the share price adjustment that's going to take place with USO there, but you can clearly see before we have that chance where the chart gets messed up, you can clearly see what direction we're heading. In other words, when oil to gold ratio is going straight down and starts in the upper left and ends in the lower right, it basically means that gold is just destroying oil right now. And for those of you that are regular viewers of this presentation, that should be no surprise to you. You guys should already have that down completely, right? We've been talking about it for a couple of months at this point. So anyway, that just kind of confirms it visually for your eye there. It's interesting to note that stocks continue to surge, whereas commodities in general are struggling. So remember, this DBC that's used here is going to have a little bit of gold in it, which of course gold has been doing well, but it's also going to have oil and natural gas and maybe some iron ore and other soft commodities like corn and wheat and different things like that. So in general, this has been a market that has been pushing towards stocks ever since they bottomed here right around the 23rd of March. In terms of any others that are catching my eye here, be aware that growth stocks versus value stocks has been kind of a money maker in recent years, where growth stocks have hugely outperformed value stocks. But similar to what we saw there with equal weight versus market cap weight, notice what happened the last 2 days right here on this particular ratio chart. You saw value come back with a fury. Remember, if the candlesticks are going down, it means that the second one here in this ratio is leading the way. If the candles are largely going up, which they have been for the last 3 months, growth stocks are outperforming value stocks. But for the last 2 days, we have seen value stocks outperform growth. And that's kind of what I've gotten the sense of as well when I've been looking at the stock market out there, just generally speaking. Some of you that follow me on Twitter know that I've been talking about some of those tanker stocks as just one example of value stocks that were trading below their book value. One of them that I tweeted about just 6 days ago is up 42% since then. Another example of that was in this very presentation. It might have been a week or two ago. You guys will recall that I did those highly speculative long call leaps on Discover Financial, the credit card company, because it was trading below book value, and that stock was up like another 6 or 7% or whatever it was today. So that trade has been working out very nicely for us. So I have been kind of just generally speaking sensing this out of the market the last couple of days. These charts here help confirm that that wasn't just a one-off situation that I'm recognizing out there. That's kind of happening across the board right now. Whether it continues or not is anybody's guess. Right now, I would say the trend still favors growth stocks, but if that will ever fall out of favor, it's going to start with two candles that look just like the last 2 days here and continue to break down from those levels. So let's keep our eye on those ratio charts there as well. And then one more down below here that I'll talk about before we move on. In the blue color in the lower right here, this is small caps versus mega caps. So we're using IWM versus DIA. IWM tracks the small cap Russell 2000 index. DIA, of course, tracks the large cap or the mega cap Dow Jones Industrial Average. So think of your big blue chips there. And notice the nice breakout we've had here for small caps. This is even more impressive than what we see over here in a lot of ways for equal weight versus market cap weight within the S&P 500 itself. Here you're actually seeing candlesticks breaking above those prior resistance points right there that occurred back on April 9th and then again on March 31st. In fact, that happened yesterday. Today was a continuation of that theme with, again, the small caps being the only index out of the four we track at the high level being up today and up over 1% for the Russell 2000. So that's something that we want to keep our eye on, because remember, these are all things that have not been normal. These are things that we had assumed for so long, well, growth is always going to outperform value, and the mega cap tech stocks are always going to outperform the rest of the S&P 500, and the Dow Jones is always going to outperform the small caps, because we've been kind of trained that way for several months. But here we are starting to see some changes occurring just below the surface, and we want to keep our eye on them, because when we see those big types of changes, that's where you're going to see some bigger than average opportunities as well. A lot of those small cap stocks have been bludgeoned over the years. There could be some true upside potential in some of those names. So let's keep our eye on it. Let's go ahead and do a little bit more 12 grid analysis here, coming on over to the asset classes, chart 5A. And here you can see that we've got a lot more green charts on the board than pink charts. Remember, the background colors will tell us whether we have a bullish posture or a bearish posture using the market forecast intermediate line. And so on the bottom rung here, we do have UUP, USO, and TNX. So that's the US dollar, oil, and interest rates still with bearish postures. These two over to the right-hand side have been a continuation type of a move that we've been talking about for quite some time. The one over to the left, the US dollar, is a little bit more important to kind of point out and specify, because we now see that the US dollar is trading below its moving average, and it's actually done that for 2 straight days. Now, I know that doesn't sound like a lot, but keep in mind that the last 2 times that it tested the 30-day moving average, it only spent 1 day below it. It did it right there on April 14th, and it did it again right there on March 27th. And then the very next day after that, it started its bounce higher. So this one's looking a little bit more precarious this time around. You can see that the moving average color itself is kind of yellow and red in that case the last couple of days. And so there might be a little bit of a change kind of shifting over there, and perhaps that will play into some of those themes as well. Remember, the general idea there is, if the US dollar is weak, you oftentimes find the foreign stocks do a little bit better on a relative basis. You often find commodities doing a little bit better on a relative basis. So right now it's too early to call whether this is a trend change All we know is that there is a little bit more selling than what had typically been the case in the past. Let's go ahead and take a look here up at the top just to kind of continue that conversation. You will see that foreign stocks, so the developed foreign stocks were up 0.75% today. The emerging foreign stocks were up 0.19%. Again, those aren't huge moves. More important is how they distinguish themselves from what happened in the United States, where we were down 0.5% here. Remember, that also has been something that has not been the case. In other words, the U.S. stock markets have outperformed foreign stock markets. You can see right here, the U.S. stock market's only down 12% over the last 3 months. EFA is down about 18%, and EEM is down about 16%. So over a longer period of time, U.S. markets are still outperforming on a relative basis, but it does make you wonder, if we start seeing more weakness in the US dollar here, is that going to be an excuse to start looking at some of those foreign investments a little bit more closely, as opposed to what's happening there in the United States, which many of us admittedly are a little bit more comfortable with, since I know we have a global audience here, but most of us trade US stocks and we're comfortable understanding those companies. But remember, there will come a time and a place where foreign stocks easily outperform the S&P 500, and you want to be prepared for that moment in time, whenever that may occur. And who knows, maybe we're on the cusp of that. But we'll keep our eye on the US dollar for clues around that very thing. Bond market was up today, so TLT was up over 1%. Those are the long bonds and of course, U.S. government treasuries there. And that means the opposite, that we did see another drop in interest rates themselves. TNX ended up closing the session at 0.61%. So that continues to be a theme of lower and lower interest rates to record levels in many cases. Not today. We did have that record level back here in March, but nonetheless, interest rates can't even get above their moving average at this point. It's been pretty brutal there. All right, let's go ahead, take a look here now at, how about let's do the global 12 grid now. And we're going to take a look at 5E. These will be the primary global markets out there. I wanted to take a look at this to kind of continue that idea there that maybe this is a time where we start seeing a little bit more outperformance from some of those foreign markets. And as you can see, we've got green boxes across the board here, meaning we have bullish postures across the board. The only one that's the light green color is Brazil. It struggled really badly a couple of days ago on some political news where some key officials were being ousted and this, that, and the other thing. So they're playing a little bit of catch up here today. Brazil was up 6% today, but that was after a really ugly day 2 sessions ago. The other charts on the board all have that darker shade of green in the background color, telling us that we have strongly bullish postures there. And the other thing that you can see here is that all of them have the green tails on their moving averages, telling us that price is now above a rising moving average. So price has done enough heavy lifting to the upside in the last month or so where it's actually reversed the 30-day moving average. So the hope there is that that 30-day moving average could then be used as a support bounce area if it falls, if those stocks fall, or in this case these ETFs fall back down towards it at some point in coming sessions. In terms of what the strongest of these strong charts are, what we can do to kind of differentiate these a little bit more is look at the intermediate line readings themselves. And if you were to do that, you might come away saying that Japan is the strongest foreign market. Its intermediate line is at 92 and rising, and that compares favorably to the rest of them. The other one that's doing reasonably well is down below here. Canada is at 90 and rising on that intermediate line. So we've got some technical indicators that are suggesting strength in Japan and Canada. Let's go ahead and now take a look at some sector analysis. And for that, we'll come on over here to chart 5C. These are U.S. sectors, just to be clear, so there might be some differences with foreign markets right now, and there could also be differences from a small cap perspective as well. All of these XL ETFs that we're looking at here that start with the XL are going to be your large cap or S&P 500 focused sectors out there. And so, as you can see, good news here in the United States is all of our charts are green. Again, there's going to be some that are maybe looking a little bit better than others. Again, I'll point out that communications was down 1.8% and technology was down 1.3%. Remember, communications is where we're going to find things like Facebook and Netflix, and technology is where you're going to find things like Apple and Microsoft. And I already talked about those charts and how they were part of the reason that the S&P 500 suffered today. So it makes sense that the communications and technology areas were the ones that were kind of beat up the most. The one that didn't quite make as much sense to me was down below here. Healthcare really struggled today as well. It was down 2% as a matter of fact. Now keep in mind, healthcare had the biggest run rate back up to its old highs as well. So that could be part of the story there. It has bounced a lot more furiously and therefore maybe needs to give a little bit of that move back, because we were on the cusp of breaking out to multi-month highs on healthcare. We were just within a stone's throw of some of those levels that we talked about or touched back here in February. So anyway, healthcare struggling today. In fact, healthcare was the sector I covered in my dividend growth investing class. So for those of you that are plus or premium members, if you want to check out that class, the recording is now posted to our Trading Rooms calendar. So if you wanted to see the two companies that have long histories of raising those dividends compete against one another on a deep dive analysis and research that I put together for my students, feel free to check out that recording here today. We've had some fairly nice picks here in the dividend growth investing class in recent weeks as the market has been finding its footing. So in terms of the biggest winners on a sector perspective today, we did have a number of them to point out. You can see energy once again was a nice leading area, 2.29% to the upside. In fact, don't look now, but we actually have an overbought cluster signal on XLE. I mean, it's been a long time since we've been able to say that. And you guys might have heard David say in the past that when you get an overbought cluster early in the intermediate move, that can actually be viewed as a positive thing, not a negative thing. Usually the overbought clusters are a problem after a trend has been in place for a long period of time. So this is actually just presenting to us the idea that energy stocks are picking up strength right now. Another area that caught my eye recently is the financials. Financials were up over 1% here today, and you can see that they are trading above a rising moving average here as well. And like I mentioned earlier, we already did that kind of highly speculative trade a couple weeks ago on those leaps for Discover Financial. So if that really was the bottom in March, we have a big upside potential for that particular trade. I wanted to focus again in the financial sector for tonight's trade application example. So for that, I'm going to come on over here now to chart 4A. And I wanted to bring up one of the most well-known financial companies, that is JP Morgan. So the banks have struggled to keep up with the rest of the market since the bottom on March 23rd. However, we're starting to see some progress here recently. We saw a lot of the asset management firms and even some of the insurance companies up significantly the last couple of days, and now even some of the banks are starting to participate a little bit more. I don't want to make too much out of this because JP Morgan was only up 0.71% today, but remember the S&P 500 was down today. JP Morgan is one of the biggest financials out there, with the exception of probably Berkshire Hathaway within XLF. So the fact that it was supposedly the mega caps that struggled today versus the smaller companies, that didn't stop JP Morgan, one of the biggest whales out there in the financial space, from rising here today. And in doing so, you can see what happened to our chart. The chart went from light green to dark green, and that signifies that green line, the intermediate line on the market forecast, has now risen above that indicator's midpoint. So it's now above 50. And anytime it's between 50 and 80 and rising, we do consider that to be strongly bullish. It's the first time it's had a strongly bullish posture since going back here to February. This is a company who's fallen off so much that its dividend yield is also deemed attractive. So not only is it turning around and reversing bullish in the short term with that green moving average as well, telling us price is now above a rising moving average in addition to that bullish posture. But if we were to come on over here to my dividend stair step chart and then type in JPM, you will see that it fell sharply earlier this year and now finds itself down here in this blue zone of the dividend stair-step chart, which signifies that its current yield of 3.78% is deemed attractive for a long-term investor. The last time you really had that opportunity probably would have had to go right back here. You can kind of see back in June of 2012, you would have been able to pick it up with this type of a yield as well. But otherwise, it's been pretty rare to see JP Morgan down below that blue dividend stair-step line there. So what I thought we would do here tonight is simply sell a put. And if the banks struggle for some reason in coming weeks or months, I'll be happy to take ownership of this high quality company at these levels or below. So for that, let me come on over here to the trade tab. I'm going to bring up our options chain. I'm going to come out here to the June contracts. The other thing I should mention is, remember, JP Morgan already reported their earnings, so we don't have to worry about some sort of a seismic gap as a result of a poor showing from an earnings perspective. So that's out of the way. It means that we can kind of get back to just more organic trading, I suppose you could say. And so for these sold put ideas, what I typically do is I look for the 1% return on risk. Now, for those of you that want to be a little bit more aggressive, there's nothing wrong with that. You could maybe look at selling, some of these other contracts here. Perhaps you like the stock right where it's at 95, and you were bold enough to sell the at the monies. The benefit to you would be you, of course, get a much greater reward for doing that. You would get about a 7% return on risk if you were willing to sell the 95 strike there in the month of June that have 52 days left until expiration. I'm not quite as bold. Now, part of the reason behind that isn't because I dislike JP Morgan as an investment. I think it's kind of interesting here. More so, I'm a little bit just nervous that we've gone a long ways. We're up more than 25% off the bottom of the market. And I don't really want to get trapped if I don't have to. We've got plenty of other bullish trades that we put on over the recent weeks where we don't need to be overly aggressive with something like this. So I'm going to keep it pretty basic here. I'm going to go with that $65 strike. You can see it actually traded exactly at 65 cents to end the day. There's about 1,900 contracts there in open interest, so this is going to be plenty liquid for most folks that are trading in this particular market. The other thing that it would do is it would only force us to buy 100 shares of JP Morgan if it were to fall well below its 52-week low. You can see up here its 52-week low back in March was $76. We're saying by selling the 65 put that if we are forced to buy it, we will be buying it at $65 per share, a full $30 lower than where it's trading right now, yet we would still be able to get basically your 1% return on risk right there. So I'm going to go ahead and click the bid. And I am going to change this to 65 cents down below here so I can get 1% of my strike price of $65 strike price. And I am also going to change this to a good till cancel order, just in case it doesn't get filled tomorrow. If there's a big gap up that occurs tomorrow, it's possible that it needs to be in the wings, kind of waiting to be filled for a few days. I'm going to do a couple of contracts on this because I don't have too much fear with that strike price. I don't think JP Morgan's going to find itself down at 65 52 days from right now. But if it does, I've got to be committed to picking it up at that price. But let's go ahead and click confirm and send. We're going to take in $130 for being willing to pick up some shares at an ultra low price if the market starts stumbling a little bit into the summer. All right, with that, I want to thank you for joining me. If you got value out of tonight's video, as always, the one thing that we ask for you, just simply click like and retweet for us there on Twitter. That would be fantastic. It goes a long way, helps us get to a much wider audience than we would be able to do so on our own. So thank you to those of you that consistently do that night in and night out. David should be back with you tomorrow. For those of you that are Plus members, remember to check out his Market Outlook live trade management session a half an hour before the market close tomorrow as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.